They don't tell you this part. When fear hits an economy, governments don't rush to fix the problem. They rush to control the fear. Not eliminate it. Not solve it. Manage it. Because panic moves faster than policy. Faster than money. And once fear spreads, no government is really in charge anymore. Right now, fear is everywhere. About inflation. About debt. About jobs. About whether the system still works. And that's exactly why this topic matters now. Because behind every calming press conference, every strong fundamentals speech, every emergency rescue package, there's a playbook. A quiet one. Refined over decades. Designed not just to stabilize markets, but to shape how you feel. This is how governments manage economic fear. And why the most important battles in finance aren't fought with money. They're fought with psychology. Let's start with something uncomfortable. Markets don't collapse because numbers go bad. They collapse because people believe they're about to. In 1929, the US economy wasn't instantly destroyed. People simply stopped believing tomorrow would look like yesterday. They pulled cash. They sold assets. They froze. Fear turned a slowdown into the Great Depression. Governments learned a brutal lesson from that era. Confidence isn't a side effect of stability. It is stability. From that moment on, economic policy quietly split into two tracks. One track manages reality. The other manages perception. And the second one is often more urgent. Fast forward to today. A modern economy is built on promises. Money itself is a promise. Debt is a promise layered on top of another promise. Markets are a giant shared agreement that tomorrow will be roughly predictable. Fear threatens that agreement. So when fear appears, governments respond in stages. Stage 1 is messaging. Before a single dollar moves, words do. Officials step in front of cameras. They speak slowly, calmly, reassuringly. Markets are functioning normally. The system is resilient. We are monitoring the situation closely. These phrases aren't accidental. They're designed to buy time. Because fear feeds on silence. If leaders say nothing, people assume the worst. If leaders speak too loudly, people panic anyway. So they speak just enough. Here's the irony. When officials say, "There is no cause for concern," markets often hear, "There might be a cause for concern." Which is why messaging has evolved. Modern governments don't just deny problems. They normalize them. Volatility is expected. A period of adjustment. Short-term pain for long-term stability. Fear becomes framed as part of the plan. That's stage 1. Stage 2 is signaling. This is where central banks enter the story. Institutions like the Federal Reserve don't just control interest rates. They control expectations. When the Fed hints at future actions, markets move before anything happens. A rate cut that hasn't occurred yet can lift markets today. A warning about inflation can cool spending instantly. No law passed. No money spent. Just a signal. This works because markets are forward-looking. They price in the future, not the present. Governments exploit that. They don't always need to fix the problem. They just need to convince enough people that a fix is coming. But eventually, words aren't enough. That's when stage 3 begins. Intervention. This is the part most people notice. Emergency stimulus. Bailouts. Liquidity injections. During the 2008 financial crisis, governments didn't just rescue banks. They rescued confidence in banks. Because if depositors believe their money isn't safe, the math breaks instantly. Banks don't keep your money in a vault. They lend it. If everyone asks for their cash at once, even a healthy bank collapses. So governments step in and say, "We've got this." In the US, the Treasury and the Fed unleash trillions. Globally, institutions like the International Monetary Fund coordinated backstops to stop fear from crossing borders. Here's the uncomfortable math. Most of that money didn't exist before. It was created. Not printed physically. Digitally credited into existence. Fear was met with numbers big enough to overwhelm it. And it worked. Markets rebounded. Confidence returned. But the cost didn't disappear. It moved. Which brings us to the hidden mechanism. Fear doesn't get eliminated. It gets postponed. Stimulus pulls demand forward. Low interest rates encourage borrowing. Asset prices rise. Everything feels fine, until it doesn't. This is where the tension builds. Because managing fear today often means amplifying risk tomorrow. Cheap money creates bubbles. Bubbles create fragility. Fragility creates the next wave of fear. Governments know this. But fear now is politically fatal. Fear later is someone else's problem. That's not cynicism. That's incentives. No administration gets re-elected for responsible long-term restraint. They get re-elected for avoiding crisis on their watch. So fear management becomes a cycle. Calm the panic. Delay the pain. Hope growth outruns the consequences. Sometimes it does. Sometimes it doesn't. Now let's talk about inflation, because this is where the strategy gets awkward. Inflation is fear in slow motion. Unlike a market crash, inflation doesn't scream. It whispers. Prices creep up. Purchasing power erodes quietly. Trust weakens gradually. And here's the irony. Inflation is often the result of fear management. Money creation stabilizes markets, but too much of it destabilizes currency value. So governments face a trade-off. Protect confidence now, or protect purchasing power later. When inflation rises, the messaging changes. Suddenly, leaders talk about hard choices. Central banks become stern. Rates go up. This isn't just economic tightening. It's psychological tightening. Higher rates signal seriousness, discipline, control. Even if the economy slows, the message is clear. We're in charge again. Except, are they? Here's the reality most people don't hear. Governments don't fully control fear anymore. Markets are global. Information is instant. Capital moves at the speed of a click. A rumor on social media can undo months of careful policy signaling. A single bank failure can ripple worldwide in hours. Which is why modern fear management is becoming louder and less effective. Bigger promises. Bigger numbers. More dramatic interventions. Each time, it takes more force to calm the same level of anxiety. That's diminishing returns. And beneath it all is the question no one wants to ask out loud. What happens when fear stops responding? What happens when people stop believing the reassurances? When strong fundamentals sounds hollow? When temporary feels permanent? When debt feels too large to imagine repaying? At that point, fear stops being a market emotion. It becomes a political one. Social unrest. Populism. Distrust in institutions. History shows this pattern clearly. Economic fear reshapes governments long before governments fix economies. So here's the quiet truth. Governments are very good at managing fear in the short term. They have tools. They have experience. They have narratives. But those tools come with side effects. Debt. Inflation. Fragility. Fear doesn't vanish. It migrates. From markets. To currencies. To politics. To society. And that brings us to the unresolved question. If the system depends on confidence, and confidence depends on belief, how long can fear be managed before it demands to be faced? Because at some point, reassurance stops working. And when that moment comes, it won't start with a crash. It will start with silence.